G'day expats and welcome to another episode of Expat Chat, episode 58 today, and back by popular demand we have Mitchell Kelsey. James has been kicked to the curb. G'day Mr. Kelsey.
Hey Brett, how you doing? Thanks
Good,
for
mate.
having me back on for another week in a row, so it's good to be back.
Yeah, the audience loved you, and I think we touched on a key issue on the US side, certainly on the retirement account side, but without meaning to, we almost segued into the next episode, which is what we're going to talk about today, which is essentially US investing considerations for US-based Australian expats, and also to a certain degree US citizens who are expats in Australia as well too. That's another consideration as well too, because they go hand in hand together. Mate, we'll get the disclaimer out of the way. So all things that everyone has the pleasure and privilege of listening to and watching today should be construed as informational and educational purposes only. Please do not construe this as personal advice. If you do need personal advice, speak to someone who knows what they're talking about, like Atlas. So, mate, let's get the show on the road. So, yeah, look, I mean, certainly US, as we said in the last episode, is a very big part of the Australian expats journey. There's a lot of Aussie expats there, East Coast, West Coast, and all through the middle. But in today's modern age, people are becoming more comfortable in investing in markets and those sort of things, and it's becoming easier. And sometimes what is easy not necessarily translating to what is the most tax compliant or tax efficient sort of scenario. So just the folks out there, to explain where we're going with this, today's topic, we're going to talk about a key topic. We'll talk about other things as well, but the key one is what is a PFIC, or a passive foreign investment company, because this will have large ramifications in terms of how you allocate your money, what you invest in. So Mitch, do you want to run through what the definition of a PFIC is, mate?
Yeah, definitely. So, naturally, I guess back in 2020, we did see. I'll just sort of touch on what you mentioned before. Back in 2020, we did see a lot of new investors come to the market, particularly looking to invest in investments such as exchange traded funds. That was exchange traded products that have been in such high demand over the last 2 years, and naturally with that, ETF such a great solution for a lot of clients, just starting to invest, and just sort of wanted to, I guess, highlight some of the issues that it might cause for someone that might be in the United States. So sort of keeping on the same theme as what we talked about last week, concerns and considerations when you're in the United States. And so, yeah, I guess to give you the definition of what a passive foreign investment corporation is, or PFIC, it's effectively any trust that exists outside of the United States, and it derives its income from passive means. So generally there's two tests, and the first test is an income test. So if this foreign trust, foreign in the eyes of the IRS, is generating income, if the income generated from this trust is 75% or more in an income year, it'll be a Pfic. And then there's also an assets test. So if this passive foreign investment company, if the assets in this trust, if 50% or more are creating passive income, it will also be a passive foreign investment company.
Yeah, and I think you hit the nail on the head. It's pretty clean cut, isn't it? And people out there are probably wondering how to identify whether I've got a PFIC or not. BHP is in the business of being in business. They dig stuff out of the ground, they sell it to their clients. So that is an operating business, as opposed to a Vanguard ETF or a iShares or BlackRock ETF or whatever. There's a lot of ETF providers out there. They're actually not in the business of making sneakers or T-shirts. They're actually in the business of investing in money, and that money is passively, worked in the background by exposure to those underlying, sectors or themes or markets. What are you investing that ETF in? So that's always the easiest way I say to clients is to identify whether you got a PFIC or not. Is it a business? And Vanguard, yes, Vanguard is a business, but is the actual business of products, services, and those sort of things, as opposed to taking your money and allocating it to a market or a sector. And that's the first and easiest way for clients to determine why that's a key consideration. So for those expats in the US or those about to move to the US, if they do have a PFIC, what are the ramifications of having that?
Yeah, so it really just comes down to, how long you've been holding that passive foreign investment company, and whether or not, at what point in time have you informed the IRS through your tax return that you have one. If it's a case where, you've been in the United States for, 5 years, for a longer term, stint now, and, the IRS isn't aware of this investment that you've been holding, that's when you then dispose of this passive foreign investment company, that's when some more significant tax implications can sort of come about, and you can actually pay tax on the unrealized growth, or the in the case where you're selling it, the realized growth of that passive foreign investment company at the highest federal income tax rate in the United States. So it's generally about 40%. And in addition, it's treated as ordinary income as well. So it's not actually, you don't receive, the more concessional tax treatment of a capital gain. Yeah, so you can't offset the capital gain using capital losses. It's ordinary income and subject to, the federal income tax rates in the United States.
Yeah, and that's, I think, a good point, because the tax rate that you're taxed at may not necessarily be your marginal tax rate in the US. So you may be in the lower range, but if you do this and gets added onto your salary of whatever income you've earned, and then it gets taxed at the high level, which makes it especially punitive. And this is not just a plug for Atlas, but a plug in general of why it's important to get advice before you do move to the US, because the US has a laundry list of all these sort of crap rules, that only apply to the US, and you can avoid completely these issues by attending to this thing before you do get boots on the ground in the United States. And do you want to run through some of the alternatives? You can still do what your agenda is, but just in a different way. So run through the folks out there. If you do have an ASX 200 ETF or an S&P 500 ETF or a Global 100 ETF, how do you navigate that?
Yeah, certainly. So you're right. Planning ahead is crucial, and then once you might realize that you do have a passive foreign investment company, looking at some alternatives. So say you still want to have, you still want to invest in exchange traded funds. A really common solution is potentially looking at some US listed exchange traded funds, because by being US listed, they don't sort of meet that first part of the passive foreign investment company definition. They're not foreign in the eyes of the IRS. So by being US listed, that can sometimes be a solution. There's plenty of, there's a couple of ASX 200, ETFs that are listed on the NASDAQ or the New York Stock Exchange, for example, that you can access and still gain that exposure to the Australian market. And, in addition to that, there's a couple that there's not a lot of. There's Australian listed exchange traded funds that are US domiciled. So basically the company operating that exchange traded fund, I guess.
VanEck, from memory, is it VanEck was the one that does that?
VanEck might have one, and then there's also, I believe, Vanguard has one as well, has one or two. So they're US domiciled. So again, not posing that passive foreign investment company, because they're not necessarily foreign in the eyes of the IRS. Yeah. So those are two really common solutions, I suppose. And as opposed to going down the route of looking at direct shares, for example, because again they're not going to pose that passive foreign investment company risk.
No, spot on. And I think coming back before about the preparation work you can do overseas, what a lot of people don't realize is, people might go, but I'm sitting on capital gains, I don't want to crystallize those gains, so I'll pay tax. But what they probably don't realize is that technically you should be paying capital gains tax before you leave anyway, because that comes down the route of deemed disposal and paying that capital gains tax to almost cleanse the liability on those shares, so that when you do move overseas, as shares, managed funds, ETFs are classified as non-taxable assets, they don't accrue a capital gains tax liability to the ATO. So whether you like it or not, you should be paying capital gains tax, on the date of departure, because then from then on, you don't accrue a capital gains liability. So that's only for assets that are purchased when you're an Australian tax resident. Yeah. Do you want to run through, folks, what a deemed disposal is and what that looks like, and why they need to sort of take that into consideration while they're going through this planning phase?
Yeah, definitely. So effectively, deemed disposal is an on-paper sale of your investments that you held at the time of leaving Australia and became a non-resident for tax purposes. So it might not necessarily suit everyone's circumstances, particularly if you're only going for a shorter stint. You might have a larger unrealized gain that's sitting there. You might not want to realize that and pay the capital gains tax, because it is an on paper capital gain, and you would need to pay some capital gains tax. But in most cases where you're looking to have that longer term stint, and there's you're looking to hold those investments for the long term, you want to enjoy that capital growth. In most cases, it's going to be in your best interest to considering deemed disposal, because that capital appreciation that those investments might experience from that date onwards, you're not going to have that CGT liability to the Australian Taxation Office. So that can be a really powerful tool, or a powerful item to opt into when you're considering, when you go to file that tax return for the financial year in which you've departed Australia.
Yeah, because that's the thing. It's the old 5 Ps, and not wanting to be a potty mouth on the podcast, but prior preparation prevents piss poor performance. And at the end of the day, people come to us sometimes after the fact, going, "Oh my God, I thought I was not accruing capital gains tax because this is a non-tax asset. I've sold them. Now I'm suddenly paying capital gains tax." And they've held these things for 5, 7 years, 10 years sometimes. So it is that thing that's in the background that does cause that consternation, and does cause that friction. And then that's just with the ATO. Then if you're holding PFICs as well, that's suddenly the IRS is having their chomp, and you're going to be feeling pretty average, because you're popping it from both sides. And yes, people say, "Oh, DTAs and all that sort of stuff." But look, at the end of the day, it is a concern. It is something that can be completely avoided. And that's what we always say to folks, is by getting advice, I would say 90%, 70, 80% of problems that people do experience are completely avoidable for not a lot of cost and not a lot of time or effort. It's just that care and maintenance. And before you jump on a plane overseas, before you pick your house and where the kids are going to school, these things are important, because the US is a take no prisoners sort of scenario. And coming out yesterday, the Congress has announced a $80 billion increase in the IRS's budget for compliance and enforcement. So you might be sitting there going, "Haha, they don't know about me." Not yet.
Yeah.
But they're throwing a bit of wedge at being able to find you. And today's stage of data mining and asset migrations and all those sort of things, it is going to become more and more of a problem going forward. So to me, that's that, in the past, you could just jump on a plane and, you suddenly show up and they don't know a lot about you. But, FATCA is a big part of what actually happens now in that global landscape. So do you want to run through, folks, what FATCA is, and if you are trying to fly on the radar, how it may not be the smartest idea?
Yeah, sure. So FATCA is a US piece of legislation. FATCA, Financial Accounts Tax Compliance Act, and I think as part of the FATCA Act, most US or Australian expats in the United States will be aware they have to file form, I believe it's 8938. It's basically the FATCA form. So you're reporting your worldwide assets. So and if you're failing to report worldwide assets, in some circumstances the IRS can fine you up to 10,000 USD. So there's some significant penalties if you're not planning ahead, and you're leaving off particular assets that you might need to be making the IRS aware of.
And I think that's a key point, because you may not disclose it, but what people don't realize is the platforms where your money's invested are disclosing it. Because if you've done the right thing, if you don't have an Australian address on there, and if you do have a US address, New York, Chicago, LA, San Francisco, Idaho, doesn't matter where it is, they will be passing that information to the ATO, and the ATO will be directly passing that information on to the IRS. Now, the IRS, since they turned on FATCA, I think in Australia it's kicked off, was it 2014 or 2017? I can't remember which year it was. It has a lot of money, has a lot of data to get through. But map that to the $80 billion in revenue that is received from Congress to go through that, they're going to start deploying capital very quickly in terms of getting people to be able to go through that data and data mine and data match. And, it may not be now, but that's why you don't want that hanging over your head, especially if it's an easy issue to fix. which it is, just bite the bullet and be done with it, because we've seen now the IRS is probably the most famous tax authority worldwide that take no prisoners.
Yeah.
When they come after you, they'll come after you at a rate of knots. And you don't want your time overseas to be marred by pissing off a tax regulator.
No, exactly. And I guess circling back to, the issue of passive foreign investment companies, we've talked about the severe punitive taxes that apply. There's also that reporting element. Of holding a passive foreign investment company, and generally there's a form per passive foreign investment company that you might be holding. I think it's about a 4 or 5 page form. So you can imagine if you have 10 passive foreign investment companies, it's another 50 pages that's attached to the back of your tax return. And I know, just from listening to webinars and things like that from with US tax accountants, they loathe doing these forms for the passive foreign investment companies. And they'll charge you anywhere up to $300 US dollars per form per passive foreign investment company. And just because the calculations are so complex, and I think even a lot of US accounting softwares, they can't even provide, they can't do the
like TurboTax and so all those sort of things they use.
Yeah, so you have accountants just bringing up, they've got their own custom Excel spreadsheets and working out the tax and doing it themselves effectively. So there's also that reporting element, just circling back to the Pfic item. So
you're spot on, and that will add to your compliance costs, that'll add to your tax return costs, and so suddenly you're paying the accountant more, you're paying the IRS more. It just keeps going and going and going. So I think the folks get the message. Pfics are not a cool thing to hold. Doesn't mean you can't invest. It just means we need to invest in a different way. But that's like we always talk about, when you do leave Australia, you need to take the Cuba off. You can't manage money overseas, especially in the United States, the same way you manage money when you're living in Australia. So, at the end of the day, that's a big one. Mate, well, I think we'll wrap the topic up there. We've just got another Q&A session, Q&A question that came in through the week, which I'll throw to you because it's right down your lane. Cool. Lynn talks about she's heard of different phraseology for classification of Australian super accounts, employee benefits trust versus foreign grantor trust, and the different ramifications. Can you just run the folks through? Don't go, I know you could talk for an hour on this, but just give the folks a bit of a high level differentiation between what those two types of trusts are.
Yeah, sure. So the two types, the two broad types, you've got, an employee benefits trust. That's the more favorable treatment. And that's what most Australian expats who are living in the United States, that's what their superannuation fund would fall under as in terms of how they report that on their tax return. And then you've got foreign grantor trust, and that's it receives a more harsher tax treatment. And with the foreign grantor trust, that really only comes about when you're being very active with your Australian superannuation fund. For example, in almost all circumstances where you have a self-managed super fund, that in most cases is going to be treated as a foreign grantor trust.
You're both the trustee and the beneficiary.
Yeah, so you're the grantor of that foreign trust. And again, additional forms that are required where you have a foreign grantor trust, where, not the case where it's an employee benefits trust. And there's also a bit of a look-through provision where the IRS wants to see what sort of underlying investments within that foreign grantor trust. And, circling back, dovetailing into Pfics, if you do hold Pfics, it's going to be the Pfic implications there as well. So
super's not preserved in the eyes of the IRS, and if they want, they can go straight through and tax you on assets you may not get access to for the next 10, 20 years. That's the crazy thing about it. So, mate, I think it's a good little summary. I said we could go on forever about this, but essentially, in a nutshell, employee benefits trust is where the majority of the contributions were paid by your employer. So that's the more favourable one. And then the foreign grantor trust is certainly where suddenly control becomes more part of you. And as you highlighted succinctly, that's SMSFs. When you're both the grantor, the trustee, and the beneficiary, you've got complete overarching control. And look, it doesn't mean you can't have investment ideas and selections inside super if you're an employee benefits trust. It's just you need to be careful and have different considerations as to if you were back in Australia or, you know, in other countries around the world. So, mate, I think we wrap it up there. You know, another cracking episode. So thanks very much for sharing with everyone your expert knowledge and everything. And yeah, we'll get you on in future episodes because I think this is a key consideration. These very specific US issues that are completely foreign to yeah, expats in other countries. So for those folks and the listeners out there who aren't based in the US, you know, you may have found this informative. You may have already skipped to the next episode. You know, so we'll ensure we'll find that balance between US and ex-US type of issues. So, mate, thanks very much for your time. To the folks out there, keep your questions coming in, keep the reviews coming in, and we'll see you on the next episode.
Sounds good. It's been a pleasure, mate. Thank you. Speak
Thank
soon.
you, mate. Take care.
Bye.